Welcome to Phil's Gang YouTube channel, and welcome to my stock market crises starting to unwind. Now, I'm going to keep doing these little segments to keep you aware as we get closer and closer to the actual crash. So, this should be helpful to you, and you should be ready. Now, I'm going to explain to you today why we're getting closer to the crash. But before I explain that, let me explain how an economy works, a good economy, compared to a fake economy that we've been in since 2008. The Federal Reserve prints money to give to companies or give to banks to give to companies, and the companies take that money and they put it into business investment. That increases productivity. When you increase productivity, wages increase, savings increase, startup businesses increase. So that means you have the economy getting stronger. The economy starts growing. And when you have the economy growing and strong, the stock market grows. You've got to have a good economy to have a good stock market. Well, they did the opposite starting in 2008. Did the opposite using QE and monetization of debt. Let's go take a look at the difference. Here they have the stock market going up, but not the economy. Well, that can't last long. QE simply means they print money instead of putting it to use, proper use, business investment. What they do is they give to the CEO and tell him to keep reducing his shares. And every time he reduces his shares, buys his own shares back, the stock price goes up. Reduces his shares, stock price keeps going up. When you keep doing that over time, soon the company is not using money to grow. They're not using productivity. And what happens then is they get deeper in trouble. While their stock is going up, the company gets deeper in trouble, and so does the economy. So then they decide to do monetizing of debt. What does that mean? They go to the company and they say, all right, well, let's do phase two. What we'll do is we'll now monetize your debt. We'll take your debt, your bad debt that's on your books, and we're going to take that from you. So your balance sheet is clean. And we're going to give you a credit card so you can keep spending. So what they do is keep these bad companies alive. And that's a problem. It used to be when we had a crash in the market, we get rid of all the bad companies. We'd go into a deep recession, which was painful but good because we would tighten our belts, meaning businessmen would tighten their belt, corporations, the government would, households would. So when you came out of that recession, you had a strong economic growth. You were strong. Then the economy grew to 4 to 5%. Well, they decided in 2008, instead of doing that, keep all the debt on their books and just grow the stock market without the economy so the 1 percentile, the CEOs, their partners on Wall Street, can get very, very wealthy. They didn't care about Main Street. Now, there's a problem with that, the printing of the money to go in and give them the CEOs to keep reducing their own shares so the stock price goes up artificially, or printing money to go in and give it to them to buy their debt, to give them a credit card. It's called inflation. And when inflation starts going up, it becomes dangerous because your 10-year treasury yield starts going up, meaning your interest rates start going up. And when your interest rates going up, it kills your economy. Finally kills your economy. All purchase, people just stop spending totally and you crash. So this is the difference. Here is monetization and QE. It's all fake. Instead of building the economy, they build the stock market, and it only benefits the top 1 percentile. And it benefits the 1/100th of 1% who control not only the Federal Reserve, but they control the 500 companies in the S&P. So they only care about the stock market. But as I say, it only can last so long. This is what you want to do. You want to be growing the economy with good jobs, productivity, good wages. But they decided not to do that. So how close are we getting to this crash? Let me show you on this chart. When you go back and take a look at a chart, okay, you can see from this point right here that the market You see how tight this is right here? See how tight that is? That's called the cluster. And then you see how all of a sudden you see how the cluster all of a sudden it broke. That's a warning. That's a warning. Something's wrong. Something's going on here. Okay, interest rates are starting to rally too much. Then all of a sudden they got it back together. That means everything's fine. But here was the terrible thing right here. You see this? When it's this wide, that means you got a huge problem. That's like a cancer. Here, a little bit of cancer started, big cancer. And that's where we are now. And the last stage of this cancer is when remember when the market dropped 38% and they pushed it up 42% by doing QE and monetization of debt. Okay, they're at the end of the road here. So we're starting to see the 10-year Treasury yield rise, and I'm going to keep watching that for you. And the more the 10-year Treasury yield rises, that means the economy's going to start getting worse. It's already bad. And I mean, how much worse can it get when you take a look at it, right? Right here. Here's the economy. So this benefited everybody except Main Street. It benefited the CEOs and benefited the 1% and the 1/100th 1%. But the day is coming, and it's coming close, as I just showed you. We're getting closer and closer. So what I'm going to do, every Friday, I'm going to continue to do these little segments for you. And I'm going to do these little segments, and I'm going to turn around and put them up every Friday. And so I'll help you go right up to the crash, so you're not going to be surprised. Remember, please, if you like this, would you please do me a favor and hit like, subscribe, and please share this. And also listen to my show on my YouTube channel. It's at 3 o'clock Eastern every day. I will see you on the chart. That's philsgang.com. See you on the charts.